getting inflation is easy, and getting deflation is likewise easy. It's just about money supply. But nobody wants to have deflation, because if these Western governments get deflation, their debts are going to go up, and people's salaries are going to go down, and therefore the tax take goes down, therefore the deficits go up, and the value of the deficits go up.
Welcome, everyone, to another episode of Inside the Markets. Today, we are more than honored to be sitting down with Clem Chambers of InvestorsHub.com. Thank you so much, Clem, for joining us today.
Oh, great to be on. Thank you for having me and inviting me on. I don't know what being more than honored is, but please feel free to feel that way.
So what are we looking at right now in the markets, in particularly gold and silver, as it relates particularly to the miners?
Well, I mean, I find gold and silver very fascinating right now, and I'm literally up to my ears in gold in particular. And it's fascinating because the blooming thing's not going up. And, you know, it's when I was a child of about 7 years old when I bought my first gold mining stock. And it was a Australian gold mine called Metromar Minerals. And I bought it at 7p and I sold it at 14p. And, you know, that for me, that was a great thing as a 7-year-old. And by the way, they've come back and they're going again 50 years later. It's called Claudius or Claudius in Australia. But anyway, that's gold mines for you. Anyway, and so it's fascinating. And the 101 of gold mining is inflation equals gold going up. So, you know, inflation was obvious to me anyway about a year ago. And I was writing about that in Forbes. And all the geniuses of economics, those guys with the Nobel Prize, were saying, "Oh no, deflation, no deflation." I'm going, you can't go printing all that money and expect to get deflation. What planet are you on? We're going to get inflation. We're going to get high inflation. And you know, I've been doing calculations on and off for the last 2 years, probably 50 to 100% inflation in, you know, globally, and maybe a bit more in Turkey. It's going to be a lot more, but in America, 50 to 100% inflation in the next 3 to 5 years. And if they keep on printing, which they may well do, I mean, you saw what happened with the Omicron scare. Everyone goes, "Oh my God, oh my God." Well, you know, if that is more lethal than the one that we've got, boy, are they going to have to keep printing. And that means even more than the 100% that we're probably going to get in the next 3 to 5 years anyway. And if you go look at the Congress's budget projections for the deficit, in 20 years, it's going to be 260%. Or, you know, something off the dial. The debt to GDP goes exponential. And that's the American Congress predicting it, not some bunch of doomsters. That's them. And you can go and pull it up off the congressional website. And you look at it, you go, oh my God, is that your projections? Well, it doesn't take a genius, or even, in fact, even someone that's more than 8 years old to work out inflation equals gold going up. But it isn't. So I find that fascinating because the market is normally quite good at being right. And as we've seen over the last 10 years, gold has gone up significantly. And I remember being looked at by a load of fund managers as if I was an alien when I suggested it was going to go from whatever it was, $300 to $1,000, which I thought is relatively, you know, a no-brainer. And of course, it's done better than that. And it's taken a long time to do it. But the interesting thing is, I thought, well, I'm going to have to go back to basics here. I'm going to have to go back to the days when I was 10 and have a look at the 70s, because the 70s were obviously for the people that are alive anyway, the moment of inflation when they actually noticed it. I mean, inflation was actually huge straight after the Second World War. Or you could say from the beginning of the Second World War, nobody noticed that there was massive inflation going on because in Europe, you couldn't buy anything. You were rationed. So you didn't notice that your eggs had gone up 300%. But after the war finished, there was still rationing. So people still didn't really realize. But between 1947 and 1972, things like collectible antiques went up 200 times, not 20 times, not 200%, but 200 times. So stuff that you could buy in 1947 in Christie's, you know, a Van Gogh or a Ming vase or whatever. By the time it got to 1972, they got up 200-fold because no one had any money in 1947. And then, of course, they went on a printathon because they had to dilute away the national debt, which was off the dial. Oh, that rings bells, doesn't it? So anyway, it went off the dial. Gold, of course, didn't really go up. I think it didn't even go up at all. It remained at $25 until they took the lid off when they went away from the monetization of gold with Nixon. And then it went absolutely spastic. maybe that's what's going to happen next. But if you take it from the moment of 72 and you look to say 81, which was that period that people recognize as inflationary, they don't think of the 60s as inflationary, where they were heavily inflationary, and so were the 50s, but they think of the 70s as runaway inflation. And that runaway inflation, you think, well, gold's going to do this. But it doesn't. It goes bang, crunch, flat, bang, flat, crunch, bang. It doesn't go up in a straight line. There's all sorts of kinks and bends in it. In fact, there's a period, I think it's 75 to 77, when it actually kind of goes down and stays down. That's interesting, because that goes against your instinct of, you know, you're going to get 9% inflation, gold's going to go up 14%, and it's all going to go like a bond. But it doesn't. Gold doesn't behave like that. Well, it didn't in the 70s. So if you're looking for an analog, you can't get gold to just go tick, 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 tick. But the flip side of that is, you know, so maybe next year it will be a year for gold, and then the year after it won't go up, and then it will go a big jump, and then it go down, and then but over the long term, the expectations is high. But obviously for traders and for people that, you know, have had some fun with crypto, you know, waiting for days, it's too long. Waiting for weeks, what are you talking about? Waiting for months, you must be mad. Years? No, you're mad. So there is an element of compare and contrast with other markets. But of course, I'm an equity boy. So I go, gold, yes. I just remember being 8 years old and gold's going to go to the moon. Well, maybe it turns out not in such a hurry. Look at the miners. Well, I mean, you look at the miners, some of these guys are throwing off 5, 6, 7% yields. What? I don't, sorry, how much? BHP, which I grant you is not a gold company, but it's a miner, is paying 11% dividend. 11% dividend. And there's inflation everywhere you look, and it's paying 11% dividend. I mean, it just doesn't compute. So, you know, I'm caught between, you know, the market's never wrong, right? The market's always right. It's a perfect pricing mechanism and all that sort of stuff. And I've made a lot of money not arguing with the market. And the market in the past is very, very, very efficient, is the market. Well, was. Maybe still is. So if it is, I'm completely wrong. I'm an idiot. But if the market is wrong, I'm going to make a ton of money for sure. And you say, well, how can the market be wrong? That's the key question. How can this market be so blooming wrong? And there's two things that I look at and I pray to be right about. And the first is the Fed. Now, the Fed is basically rescuing the whole world from a financial collapse like no one who's living has ever seen. Or maybe a few people that were cognizant in the 1930s. And even perhaps worse than that. The sort of economic collapse that the Germans experienced after, you know, the Third Reich fell, or Venezuela is experiencing now. Because without them basically bailing everybody out, without them writing checks to not just corporates, I mean, let's face it, you know, a fair amount of corporate welfare going on, but that's what employs most people. And most people want to keep their job. They don't really want their corporation to go bust. I mean, they might go, it's not fair. But wow, it would really be a lot less fair if their corporation went bust and they couldn't pay their mortgage and they went bust and the house got repossessed and the house prices collapsed, etc., etc. And if the Fed wasn't doing what it's doing, make no mistake, the world and all the other central banks, the world economy would collapse and we'd all go down with it. So at the end of the day, I don't care how many Cougarans you got in your sock. It ain't enough. Yeah. And, you know, when times get bad, people give away their gold for a bar of soap. And, you know, the world has just lost 10 to 20% of its wealth. 10 to 20% of its wealth because of the, you know, COVID actions to stop all the old people dying. Yeah. And most people were prepared to pay that price. But the ramifications of the global economy with all its leverage and all its fiatness and all its rehypothecation, etc., all its big fat house of cards, all its interlinkage, all its dominoes, all nicely lined up, it can't take a 10 or 15% haircut in its wealth and not absolutely implode. And the Fed and all the other central banks know that. And they've been pumping this money out to pay for it over, to bail everybody out. But of course, if your production goes down by 20% and your money supply goes up by 30%, well, you get inflation, don't you? It's Milton Friedman's first law. Inflation is always and everywhere a function of monetary policy. in so much as inflation occurs when money supply outstrips output. I mean, you can check that quote. It's not exact, but it's close enough. And that means if you print more money, if your output goes up 3% and you print 6% more money, you're going to get inflation. Well, output's gone down and money supply's gone up. So you're going to get inflation. You can't not get inflation. And, here we are. And they're all saying, oh, no, look the other way. It's not us. It wasn't us. We didn't do it. It's over there. It's them over there. It's this over there. It's not us. Of course it's them. But they can't say it, can they? They can't say, look, boys and girls, you're going to take a haircut. And that haircut's going to be put on you by inflation, which is a tax on everybody. Because as a society, we've lost 10 or 15% of our wealth because of COVID, one way or the other. And so have you. So, suck it up. They're not going to say that, are they? Because they wouldn't keep their jobs, nor would the politicians. But that's the reality. And you can see that in the debt to GDP levels that you're dealing with all around the world. Well, they've got to get them back into line. Now, of course, there's another option. You go, I'm your elected president or prime minister. You're all going to suffer now for 2 or 3 years. You're all going to take a pay cut. We're all going to, cut all your services. We're not going to, cut our army in half. We're going to stop giving out aid to the third world. They can starve. We're going to cut back on everything. We're going to take pay cuts ourselves. And we're going to have austerity for 3 to 5 years. And we're going to have a budget surplus. And we're going to claw back what we just spent. Yeah, right. Pigs might fly. Instead, they go, oh, no inflation here. Oh, no, it's only short term. Oh, no, it's nothing to do with us. No. Oh, it's not as bad as it looks. Oh, no, it won't be there tomorrow. Oh, no. And then 5 years later, they're back in balance again because the inflation has dealt with their debt to GDP. And that's what we're in now, 3 to 5 years of that. And let's just hope that they slow down it. And I think they'll slow down this printing. If you look at the Build Back Better, Mr. Biden's plan, well, boy, did that take a long time to go through. And boy, did that shrink and shrink and shrink. And it wasn't as if any one particular side was in a hurry to get it through, were they now? They're all going, oh, well, we can't get it through because the other side is being difficult. Oh, we're not getting it through because that side. Everyone's blaming everyone else on it not going through. But the fact is it shrinks and shrinks and shrinks because they all know if they keep printing money like this, that there's a chaotic financial problem, another crash coming. But if they keep it moderate, as they have just about kept it in line with what's row or backable over 4 or 5 years, something that it can be ground away at, and nobody who doesn't know about economics or finance will work out, and they can get away with that. And that's what they're going to be doing by giving everybody a haircut of about 50% of their liquid assets, of their cash and their savings. And for people who haven't got any savings or got debt, of course, they're going to make money out of it. The economically active are going to have a great time because inflation is the best friend of the entrepreneur. However, well, as I think, what was it Trump said, I'm a kind of like low interest rate inflation kind of guy. And anybody that's economically active is going to be doing great. The economically passive, the retired, the savers, well, and the poor and the unemployed, they're going to have a terrible time. But meanwhile, on the markets, those miners, they're paying out 5 and 6% dividends in Europe, and even America, the land of what the hell's a dividend, are paying out 2s and 3%, new months of this world, etc. So it's like I can't believe my eyes, and I'm either horribly wrong about the whole thing, or I'm, the world will catch up all of a sudden, and I'm going to do very well out of it. I can't for the life of me see how I can be wrong. The counter argument is we're going to have this little rush of inflation, and then we're going to have a catastrophic deflationary situation. Well, in Japan, they've suffered from deflation for a generation, and they go, oh no, we can't fix it. Oh no, we can't do inflation. We're trying so hard. Oh, but we can't do it. Oh no. Well, that's obviously a lie, right? I mean, give me a call. I'll sort it out for you. I'll throw the biggest party on earth. I'll build the largest skyscrapers. I'll have a huge yacht in Tokyo Harbor. I'll be throwing parties like you've never seen before. They'll make Zimbabwe and Venezuela look moderate. And you'll get inflation. And they can even pay me a bonus for that. I mean, it's easy. You just print money like they do in right now in Turkey, right now in Venezuela, right now in large parts of Africa. Yeah, it's easy. You just print money and hand it out, or hand it out to yourself if you're in most of these countries, and spend it on yourself and your mates. Yeah, that's how you get inflation. But the Japanese go, oh no, we can't do it. That's because they wanted deflation because of their demographics and their long-term strategic plan for Japan. But getting inflation is easy, and getting deflation is likewise easy. It's just about money supply. But nobody wants to have deflation, because if these Western governments get deflation, their debts are going to go up, and people's salaries are going to go down, and therefore the tax takes goes down, therefore the deficits go up, and the value of the deficits go up, and everybody cries and wails and gnashes their teeth, and all they've got to do is go Control P on their printer, and out pops a few more trillions, and Bob's your uncle. You've got as much inflation as you want, and as little as you want. And these guys, I take my hat off to the central bankers and Americans. Central bank is just a fabulous group of technicians when it comes to doing all these things. When you think of the disaster of 2007 and 8 with the credit crisis there, and what they had to do to rescue the whole system from that catastrophe. GE couldn't pay its wages, their overnight pay, because in America, and still today, a lot of American corporates, they pick the phone up and they go, hello, bank, can you send my wage bill through to our account for tomorrow so we can pay everybody? And the bank goes, yes, your credit, you're AAA rated, yes, we'll send that. They don't have it there. Every payday, a couple of days before, they ring up and say, will you take our short-term paper, please? And the bank says, yeah, of course, yeah, send it along. Well, of course, in the credit crunch, when GE rings up and says, hey, it's GE, we want our whatever hundreds of millions for our pay our wages this week, they went, oh, I'm sorry, oh no, we've got a credit crunch, it's all frozen, no money for you tomorrow. And of course, they wouldn't be able to pay their wages, would they? What would that have meant? And you can see the chart's going, oh my God, GE's going to go bust. And of course, the Treasury came out, or the Fed, I can't remember which, and underwrote their overnight paper. And that was a completely innovative move. That never been done before. And they came out and they did that, turned the situation around, and things repaired, and they invented QE, and they did more and more of it. Then they thought, well, let's do QT, let's do the opposite and put it all back. Oh, whoops, nobody wants to let us put it back. The market's going down now. Oh, let's stop that. But the whole of American monetary policy, and for that matter, the world's foreign policy, has been reinvented on the hoof since 2007. And in the old days, they were just gone, oh no, I don't know what's happened. Oh, we've all gone bust. Oh, it's all bad. And oh, everyone's out of a job, like in 1929, of course. But now they're actually masters of the system to be able to rescue it. But of course, there is plenty of free lunches, but this ain't one of them. So what they've done with these two different disasters is they bailed them out, re-engineered the whole financial system. And this time around, the penalty is going to be, well, we're all going to take a haircut because the world economy took a haircut. And inflation means that money will run to hard assets. The question is, what hard assets is it going to run to? Well, it's clearly a lot of people think that crypto is a good place to run, which is why it's so high. I think it's so high now that it's not really a good hedge against inflation. It's a one-way bet on the success of crypto, because that thing can halve, and that's no inflationary hedge. If the asset you've hedged against inflation can go down 50% overnight because it's crypto. But people seem to think it's some kind of hedge. There's gold, there's art, which is a classic one, and there's property, which again is a little bit difficult because it's quite heated. But if we were to get runaway inflation, as opposed to what I think we're going to get, which is 7 to 9% for 3 to 4 to 5 years, maybe in real terms 10 to 15 for 3 or 4 or 5 years, then it might actually be, it's quite a tricky thing to pick out the assets that will give you the ease of action that you require to move decent sums around. I mean, interesting enough, I think crypto is Bitcoin is what I call lazy gold, because gold is hard work. I mean, it's hard to secure, it's hard to buy, it's hard to store, it's hard to, it's just hard. And it's hard to get the real stuff rather than somebody else's promise that they've got it and all that. Whereas Bitcoin, you just go click, 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 and you've got it. So the similarities between gold, which are many, one of them in particular is that Bitcoin is great flight capital. In fact, it's much better than gold gold used to be the flight capital. So, when your dictator would be heading for, political asylum somewhere, he'd have a lorry full of gold going with him. Well, you don't have to do that these days, unless you're, coming out of Afghanistan, like one of the ministers had to leave $5 million in cash on the runway. But of course, if you had it in Bitcoin, you wouldn't have to do that. And $5 million in gold, well, that's about, that's a few hundredweight. So, it's not practical as crypto is for that sort of instance. And there's always been a big asset class, particularly in Asia. I mean, in India, I remember a rich man telling me, he said, well, it's not wealth if you can't carry it. So he didn't mind that he had a skyscraper or two because he couldn't carry it. So therefore, he didn't really consider that to be his wealth. He considered his wealth what he could get on the back of a motorbike and head east with, which was, a pretty basic attitude towards money. But, in countries where property is not really secure, and sometimes your life isn't secure, then obviously what you can carry takes a lot more value than what is, fixed in concrete on the ground. And of course, Bitcoin, once you've got a Bitcoin, it's nowhere, it's in America. If you get a Bitcoin in Beijing today, it's in America instantaneously. It's everywhere. It's everywhere and nowhere. So, that's why the Chinese have banned it.
Tier 1 Silver is an exploration company focused on creating value for shareholders and stakeholders through discovery of world-class silver, gold, and base metal deposits in Peru. Tier 1 Silver trades as TSLV on the Toronto Venture Exchange. It just hit its first high-grade silver drill intercept, its Curabaya project. The company believes they're on the cusp of a massive silver discovery. They're currently expanding their permitting to aggressively pursue multiple targets that have been identified on the property. For more information, visit tier1silver.com.
So I wanted to ask you, you kind of answered this question, but I'm curious, if you're right, how do you plan on making a lot of money?
Well, I've pivoted a bit because I thought gold would go on a run, in fact, months ago. I mean, I'm counting my dividends going, oh, that's rather nice. Why isn't gold going up? So I think the way always is a diversified portfolio risk. So one of the ways is to buy, the GLD ETF, which I have some. One of the ways is maybe to buy some, calls, way out in 2023 or whatever. So, which is relatively cheap. In fact, it was sillily cheap. But that should be a lesson right there for me. And then you buy the stocks, and then you buy some physicals, and then you might, if you know what you're doing, look at some high quality numismatics. And if you really are brave, you might want to buy jewelry at auction, proper auctions, not ones where they, fully valued, but the sort of auctions where your high quality jewelry goes for 25% of what you get it for if you put it at retail. But personally, I've gone options, ETFs, stock, and physicals. Not actually in my sock, but physicals through people that hold and look after that for you. And there's people out there like Kitco that will do that for you. But obviously, counterparty is quite an important thing. And then you just have a portfolio of risk. One of the troubles with stocks in gold is that they're in some dodgy places. Some of these stocks, and there's a quite an interesting company called Hochschild. I can't pronounce it. Can't spell it either. But the Peruvian government came out and said, "Oh, you miners, you're all swines, and we're going to cancel all your mines." Oh, great. So the blooming stock goes down like 60% instantaneously. If you're a trader, that's joy, of course, because then you buy some and it pops up 30% and you've made some money. But that's a different game altogether. But that is the trouble with most gold mines, is that they're in weird and wonderful. Putin's got a lot of them, and Africa's full of them, and there's various dodgy political things going on all over there. And you have to get back to places and mines which are on solid ground. It's quite difficult, and so you're forced. I wouldn't say that unkindly, but the majors are quite good like that. So the Newmont minings as well, the Golds, the Barricks are interesting because they are onshore, so to speak. And of course, gold is one thing, silver's another. And Mexico is a haven of normality in comparison with a lot of places that have precious metal mines. And so there's silver in places like Mexico, like Fresnillo, which is interesting. And there's platinum. I love platinum. I can't get it through my skull why it's not gone a lot higher, because platinum, palladium, all that lot is all plugged into the hydrogen economy that's coming. And you need platinum and palladium for all these fuel cells and all that sort of stuff, all these catalysts that are going to be driving all the new tech that's coming down the line, you know, and they don't make much of it. I mean, it's something ridiculous, like only 10 tons of platinum a year made. I mean, it's such a low number. I didn't even want to say it because it's ridiculously, it can't be that little, but you should look it up yourself. You go, how little? What do you mean the whole planet only makes 100 tons or whatever the number is? You know, it's a very, very interesting dynamic. And of course, the precious metals you can get your hands on, but there's all the exotic metals also, which also come under the heading of inflation hedges, but also have this zap with all the wonderful technology that's coming our way in alternative energy and, you know, electrification of vehicles and stuff like that. So, and all the exotic electronics that we're producing these days. Harder to get hold of, again, you know, is something that you want to look out for stocks. And the more boring the stock, the more I like them. But obviously, most of your viewers will want the craziest one, you know, something that's got, you know, a iridium and arsenic mine in Siberia and Antarctica or something like that. You know, that's the stuff that people love, and that'll give you your excitement, that'll give you your beta and then your alpha if you get it right. But you know, personally, I'm happy with something like Stillwater unpronounceable, Sabani Stillwater, you know, a great platinum play, a palladium and platinum. I mean, you know, tremendous. So there's a huge amount of real value out there in the precious metals, and I'm a value investor, and I love value, but it feels a bit uncanny to me that these things are so great value, paying fat dividends, and got the future in front of them of all the demand that they're looking at. Plus, you got this inflation thing that at the moment looks like it's going to be an elephant, but it could be a monster. So, I mean, it's bizarre to have all these functions pointing at one point, saying this is the way to go, and there's, you know, crickets.
It's tough asking the questions around here. Clem, this has been a fascinating discussion. Thank you so much. We've had the honor and the privilege today of sitting down with Clem Chambers. He is the CEO of ADVFN, which is, I believe, the company above Investors Hub, which is one of the leading investing websites for Americans on the web. Thank you so much, Clem, for joining us today.
That's my pleasure, Justin. I'll let you ask me some questions next time.
And thank you, everyone, for listening.
Bye now.